Good morning, Mark.
Morning, Andrew.
To you. Thanks for speaking with Blue Notes this morning.
Thank you.
To cut straight to it, it's a tough result for the institutional division in the half. Can you take us through the major issues and what you can do about them?
Look, it's a very disappointing result, so that's the only way to look at it. But these are probably the toughest conditions I've seen in the institutional market in 25 years of banking, and it's almost like the perfect storm. You've got low margins, you've got widening credit spreads, you've got trade volumes down, you've got lots of volatility in our balance sheet, and you've got very low interest rates. And it's a combination of those things that have meant that our revenue has been challenged, and so it's been a difficult market. That said, we're doing a lot of good things to correct the ship. Effectively, we've been focusing on simplifying the business, taking a lot of the costs out of the business, and at the same time really concentrating on those customers that are returning low value for us, and therefore moving away from them and deploying the capital to better customers. So there's a number of things underway which we can do to ensure that the performance improves.
Yeah, you were talking before we started about having to cut the cloth to suit the climate that you're in. When should investors expect to see those sorts of things coming through? Is it a marginal increase bit by bit, or over the next 6 months?
I think if you get through some of the noise even in this half's results, you'll start to see there's some really good signs there, because as I said, with the simplification that we've been doing in the business, we're already starting to see in the underlying expense numbers, we're seeing that improve, so they're coming off. So that'll continue and continue in the second half and into next year. The risk-weighted asset reductions that we've had is already having a real positive impact on net interest margins, and that's another very good sign. So that will continue, and when will we see it really back into the shape that we like it? I think this is a 2 to 3 year journey, but it'll be an improving story across those halves as long as we stay disciplined. So I think the signs are already there, but it'll probably take a little while before we have it in the shape that we want it.
Well, one positive aspect here was cash earnings in the result. Is that going to be, it should be the focus? Is that something you can continue then?
Yeah, look, cash earnings, they were terrific. I mean, cash was up about 5%, PCP, but trade was down. So the numbers overall in transactional banking look down. However, that's a really good sign for us. You remember, we're in a low interest rate environment, yet we're seeing our cash earnings grow. That means we're earning a lot, doing a lot more with our customers in a transactional banking sense. We want to see that continue. We want to see that continue. We want to see trade growth come back, and we also want to see our markets business contribute. So we're looking to get a better mix for our business. They're high ROE capital light products, so we want to continue to focus on those and move away from the heavy capital related products. So we're going in the right direction there, and I was really pleased with that result.
And you talked just before about the risk-weighted asset story, which was helping margins, but one of the downsides is it affects customers and there's a revenue implication.
Look, this is a discipline that we're deploying, and not dissimilar to a lot of other banks around the world. Where we're focusing on that is on customers that have perennially not really paid us for the capital that we've deployed to them. That's the first thing. And so we're having conversations with them around whether we can improve the mix of our business to get our returns up. If that doesn't look like it's happening, then we're obviously reducing the assets that we have to those particular customers. We've been doing that in the emerging corporate market, as you know, in Asia, and we've been having some difficult conversations with some customers in other parts, all around the globe really, to ensure that we get the right return. Now, some respond well to that, and others we can't see a way forward, so we'll reduce the risk-weighted assets. But remember also, if you look through some of the numbers, you'll see that we've put a lot of risk-weighted assets on. So while we're taking some off, we've put some more on, and those ones are coming on at very good returns. There's some new customers that are coming on that. So the mix that we're getting is actually much, much better. And if we continue that trend, we're going to have a very good outcome in the next 2 years.
You talk about Asia there and the need to rework some of the businesses. It'd be fair to say investors remain sceptical about the Asian side. Is Asia still a differentiator for you and thence valuable?
Look, absolutely. This is critical. We want to capture the regional capital and trade flows. We think our footprint in Asia is a significant competitive advantage for us long term, medium and long term. You're just seeing a cycle here, and we've got to remain committed to Asia. In fact, 35% of the returns that we make in Australia are related to the business that we have in Asia. And that's only going to continue to grow. So there's been lots of noise about us exiting Asia. We are not exiting Asia. If anything, all we're doing is right-sizing our business in all of our regions to ensure that we focus on the right customers and to leverage this continual growth you're going to see in Asia. So it remains critical to our long-term plans.
You've been in this role only for 3 months now, but you're a long-time Asia hand. You've spent time in Asia with several banks. When you're in Asia now, how different is this cycle? Is it different to previous ones you've seen?
Look, I think it's a little different because China's come off the growth's come off. There's been lots of concerns around the economy there, but you remember they're shifting from this export-orientated country to a domestic consumption and services country, and that's going to take some time. And you're also seeing at the same time Indonesia go through some significant concerns because of what's been happening in the resources sector there and around drought and a few other things that are affecting the economy. And India is just starting. So it's a different mix of what's going on in Asia, but ultimately that's going to happen over the course of the next 10, 20 and 30 years. So this is just a cycle. I don't see it as a major adjustment. I just see it as a change in mix of where each of these countries are, and the growth's going to continue. And even at 6% in China, off the size of the market that they have, that's equivalent to say 10 and 11% growth 10 years ago, just because the economy's grown so much.
Look, thanks very much for your time this morning.
Thanks, Andrew.